And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. It is a confusing moment to be an investor. There's unusually high levels of uncertainty around inflation and the state of the economy. What should your asset allocation look like in the second half of the year? Let's talk to two industry veterans who both have their hands in the ETF business as well. Jason Trennert is chairman of Strategas Research Partners. Bruce Levine is the CEO of Nightshares and was formerly president of Wisdom Tree Investments. Now, Jason, you're one of the very best people I know at the 30,000-foot view of the world overall. Tell us where we are right now on stock prices and what side of the whole recession/soft landing debate do you come down on?
Well, as far as stock prices go, Bob, I think the good news is a good portion of the multiple compression, I think, is behind us due to expectations for higher inflation. The bad news is that I'm not sure we've seen the earnings adjustment that people are anticipating yet. Right now, if you look at S&P 500 operating earnings, they're still forecast to be up about 10% next year. We think that's going to be more like 4%. And that maybe leads me to the second part of your question, which is we're more in the soft landing camp right now. Although I have to say history is not really on our side on that. Generally speaking, it's very hard for the Fed to pull off a soft landing once inflation has gotten away from it.
And of course, that impacts the whole earnings outlook. If you're on a soft landing side, maybe you're going to get 4% increase in earnings instead of 10, as some people are expecting. But if you're in a recession side, we could be down 10%.
Yeah, earnings, in typical recessions, earnings fall about, reported earnings fall about 30%. So it does make a big difference. The good news is that you do have pretty tight labor markets. You still have a pretty easy Fed, and you still have a lot of excess savings in terms of consumers and corporations. So hard landing is hard to forecast right now, it seems to be, and we're going to give the Fed the benefit of the doubt for the time being.
You know, Bruce, you have been in the ETF business for a long, long time. I mean, many, many years, decades even longer than I have. And what's amazing to me is the resilience of the ETF structure. We've had a rotten year. The S&P's down 20%, and yet we still get inflows into plain vanilla ETFs overall. It's the resiliency of the structure that's amazing to me. You're a veteran. What do you see happening in the second half of the year in the ETF business?
Yeah, I think the ETF structure has always been the gold standard for innovation, and all the good ideas come out in the ETF structure. That's going to continue. The investors have spoken. They like the structure. And so, the markets, I sort of agree with Jason, they'll be kind of shaky for a little while. But when they respond, you'll see probably record flows in ETFs.
Yeah. I want to go back to you because you've gotten into the ETF business this year, which I find very interesting. That after all these years of being a big strategist, now you're getting back into the ETF business. You launched the Strategas Macro Thematic Opportunities ETF. This was launched in January. Actively managed, you're looking to outperform the broader market by providing exposure to multiple macro thematic. This is right up your alley. But tell me about what's the idea here.
So the idea, Bob, is that all of our clients are institutional investors. So we do written research, we visit them, but there is no ability for individual investors to access our work in any way. We thought this was a way to do that. We are very thematic in our approach, and the idea is that we're actively managing the themes. So we focus on what we think are the biggest drivers of stock prices at any given time, and do our own quantitative analysis to pick stocks to play those themes. So the themes now are, as you might suspect, higher inflation for longer, quantitative tightening. We want some cyclical defensives in the portfolio, and we also like the idea of deglobalization after COVID and after Russia invaded Ukraine. So all those things taken together, I think it gives us an interesting portfolio. Certainly pretty levered to commodities and oil prices, which worked out really well at the beginning. It hasn't worked out so great lately, but we're optimistic about the second half.
So when I look at the main holdings, we always want to look at what your top 5, 7, 8 holdings are. I see a lot of commodity names. I see Occidental. I see Nucor. I also see the dollar, the U.S. dollar.
Yeah.
What's the rationale
well,
here? I can understand why commodities, because all the macro guys are really into commodities right now still, but what's the dollar?
Yeah, well, the dollar really is
right about that.
We've been right, but listen, the dollar, it's hard to see another, certainly Bank of Japan or ECB are way behind the United States, and they're taking a big gamble, it seems to me, A weaker currency on their part helps their exports. But it provides real risk to their consumers. But the Bank of Japan and the ECB don't seem to be even in the ball game as far as trying to fight inflation, whereas the Fed, even though it's late, is fighting. It's clearly fighting inflation.
So their weak currencies are going to make imports very expensive for them.
Exactly. It's remarkable how strong commodities have been, even though they've weakened recently. It's amazing how strong commodities have been, despite the fact that the dollar has been as strong as it is. One wonders what commodity prices would be like if the dollar weakened.
And just as a tourist, I was just in France on vacation. I marvel it was $1.04 for the euro. It was $1.25. Not
you're kind of through the IPO
that's worth
price.
Buying a couple of glasses of rosé.
Yeah, you bet.
A few nice shirts overall.